Good afternoon, everyone, and welcome to this conversation with Skrainka, Krilogy's Head of Research and Chief Market Strategist, and myself, Kent Skornia, President and CEO of Krilogy. Now, we have a saying here at Krilogy: we have intelligent clients, give them intelligent options, and they'll make intelligent decisions. And we believe it's our goal today to try to help you reach your own conclusions by providing you some analysis and insights, and then follow up with our investment advice. COVID-19, the coronavirus, continues to spread around the globe and has now been classified as a global pandemic. In this program, we will attempt to assess the potential impact on the global economy and provide guidance to you, our clients, who I'm sure have many questions. Alan, in your 37 years of leading investment teams and managing portfolios, have you ever seen anything like this?
No, Kent, this is unique. I've never seen anything like this. I don't think any of us really have, but let's talk about where we are today. This is a serious outbreak. According to Johns Hopkins, there are about 160,000 confirmed cases globally, 6,000 deaths. About 75,000 of those patients have contracted the disease and have fully recovered. And the U.S., there's about 3,000 cases that have been reported, and of course, we expect those numbers to increase. It's worth pointing out, though, that health officials continue to emphasize the overwhelming majority of people who do contract the disease will recover. Also, governments and health organizations around the world have mobilized resources to address the outbreak, while businesses have taken steps to limit the impact. Containment measures, including patient isolation and quarantine, active monitoring of contacts, border controls, and community education, are all measures being taken with the goal of slowing the rate of infection. The federal government, too, has taken significant steps to offset the economic impact of the outbreak, which includes assistance to businesses and workers and significant stimulus from the Federal Reserve. We believe more steps will be taken in the days and weeks ahead. And of course, closer to home, the stock market has understandably been rattled by the news. But at the same time, the bond market has held up reasonably well as interest rates have moved dramatically lower. Kent, back to you.
Yeah, I think a big question we're all asking ourselves is there any way of estimating the overall impact that this is going to have on our economy? Our economy is strong going into this, but what do you see as the overall impact going forward?
Well, of course, there's a lot of uncertainty, there are a lot of questions, but economists are beginning to adjust their estimates for growth this year. According to a survey of economists that was just conducted by the Wall Street Journal, the U.S. economy is now expected to decline in the second quarter this year after modest growth in the first quarter, which raises the risk of a recession. The Wall Street Journal monthly survey of economists found 75% of those economists expect the coronavirus spread to be a, quote, significant drag on full-year growth for 2020. Other economists have estimated the short-term impact on the economy may be closer to a 1.5% decline beginning in the second quarter. So overall, while the economic impact from the spread of the virus could be significant, the economy should be in a position to rebound quickly.
Alan, talk about, is there going to be repercussions that are felt across the economy? What should investors do if we experience a recession? What are your thoughts there?
So, Kent, while we've never really seen the spread of a virus like this before, we have experienced many recessions in the past. And the lessons from looking at past recessions are pretty clear. First, remember that recessions begin and end without warning. So much like you didn't hear many predictions that a recession was going to occur, it's most likely the predictions of when this period ends are not going to be accurate either. Recessions happen all the time, but most are very short-lived and are not as severe as, say, for example, the financial crisis we experienced 10 years ago. Historically, the economy grows more than it contracts, which is why buy and hold investing has historically worked well. And remember, diversification of a portfolio into high-quality bonds can help dampen the short-term impact of a stock market decline. Remember, too, the stock market often leads the economy into recession and leads the economy out of recession. And that's why strategies to avoid losses associated with recession usually do more harm than good. And sort of as an illustration of that, this line shows you an average of the stock market's performance heading into a recession. And then you see that dashed line in the middle. That's when the recession begins. And then the stock market bottoms out usually about 6 months after a recession starts, and then begins to recover well before the recession ends. So remember, recessions are short-term, but expansions are long-term, and that's why time in the market is more important than timing the market. And to sort of illustrate that point, we show you an example of an investor, a very unlucky investor, that just happened to invest in each of the last recessions on the first day of the recession. And you can see what his results were 10 years later. And then compare that to an investor that had uncanny timing, that avoided recessions, but invested on the last day of each of the last 11 recessions. And while he came out ahead in the short run, in the long run, these numbers are virtually the same. So don't try to time the market. And remember, expansions and bull markets have historically been much longer than recessions and bear markets.
Great stuff. Those stats are powerful. Certainly, the news is bad, though, right, Alan? I mean, the government has moved quickly to help address the problem. Will you speak about what the government's doing right now in terms of its response?
Well, the government, I think, has moved very aggressively now. The Federal Reserve on March 3rd cut short-term interest rates by 0.5 percentage point, and then quickly came back on March 15th last night and cut interest rates by another full percentage point to near zero. They also announced that they are buying up to $1 trillion of Treasury and mortgage securities, which should really dampen interest rates, both short and long term, and help offset the impact of the spread of the coronavirus. The president signed an $8 billion spending bill to fight the virus on March 6th. And then Congress has passed the Families First Coronavirus Act to provide free coronavirus testing, paid emergency leave, enhanced unemployment insurance, and they've strengthened food security initiatives and increased Medicaid funding. And we expect more legislation in the days and weeks ahead. The vice president recently said that the passage of the Families First Act was sort of the second inning, and there's going to be more to come.
Alan, you're not an infectious disease expert, but I think the lens through which you see companies working on some type of cure or efforts to curb the spread, what is the outlook for treatment on the coronavirus?
Well, there's a lot going on there, Kent. Two key ways of slowing or stopping the virus are treatments and vaccines. And there are literally dozens and dozens of companies that are vying to enter the market. One very promising drug from Gilead, it has already moved to phase 3 studies, and the experts tell us we could get some encouraging data by as soon as April or May. By last count, the pipeline contains 35 different vaccines and treatments that are various stages of preclinical trials. Here you see a picture of some of those drugs that are in various stages of the pipeline. So I think this is really encouraging. Yes, it will take time, but the pharmaceutical industry has really stepped up.
Can you sum up what the investment advice we're providing, really that comes out of our investment committee and our research department, and what our advice is to our clients moving forward?
Yes, Ken. It's really almost always a mistake, we believe, to make a long-term investment decision in reaction to short-term events. You see a lot of panic in the market, but panic is not a sound investment strategy. So bottom line, if you have a well-thought-out investment plan, and most of our clients do, our advice is to stick to it. Recognize that stock market declines occur frequently and are a normal part of the investing process. Granted, this one is fairly unique with the rapidity of the decline, but it's almost always a mistake to react to that by selling. Market declines can occur at any time for any reason. So don't attempt to avoid the decline or the impact of the decline by getting out, because it's so hard to figure out when to get back in. And keep in mind, stock market declines tend to be very short, and they're almost always followed by market rallies. The reason why is economic recessions tend to be short and have historically been followed by much longer economic expansions. And finally, focus on the factors you can control. You can control the diversification of your investments, the quality of the investments you own, and of course your own emotions by maintaining that long-term perspective. And, market declines too can be the long-term investor's best friend, because they give you an opportunity to buy good investments at a lower price.
Yeah, and I think we see that with our rebalancing feature that we have here at Krilogy, and we're seeing a lot of rebalancing going on in terms of, selling our positions that are holding up fairly well and buying into good investments at a lower price. Alan, this is market downturns like this come in all shapes and sizes, and you've been doing this a long time. Anything else you'd like to add to the conversation today?
Well, Kent, bottom line, stay calm and carry on. I would quote Dr. Anthony Fauci, who's done such a wonderful job at the NIH. He said yesterday, it's important to remember that overwhelmingly more people will recover from this virus than will get into serious trouble. So yes, it's serious, but healthcare officials have told us this crisis will last weeks or months, not years. So we are going to get through it. Once again, if you have a well thought out investment plan, our advice is to stay the course.
Thanks, Alan. Great insight, and we appreciate your time. Thank you all for your time today. Of course, if you have any questions, we at Krilogy are here for you. Don't hesitate to reach out to your Krilogy Wealth Advisor at any point. Thank you very much, and you all have a great day.